Hello everyone, this is Dr. Murlidhar. In this video, I am going to explain you about accounting concepts and principles. Basically, what do you mean by the accounting concepts and accounting principles? First and foremost, we need to understand. Normally the accounting principles means there are some rules, regulations, actions, procedures adopted by the accountants globally for recording accounting transactions. Virtually, the financial statements are produced, the accounting principles for its uniform understandings. The accounting principles are classified into two categories. They are accounting concepts and accounting conventions. First and foremost, what do you mean by accounting concepts? These are the assumptions and conditions on which the science of accounting is based. Accounting is an art as well as science. So, in the definition, we are calling it as accounting is an art of recording, classifying, summarizing in significant manner. So, the science of accounting is based on the assumptions and conditions. So, what do you mean by accounting conventions? The conventions are nothing but it is a customs and traditions that will be helpful for the accountants for preparing accounting statements like trading account, profit and loss account. Normally, we call it as an income statement and balance sheet. So, the accounting concepts and conventions are very useful for preparing financial statements. Having said that, let me go for one by one about accounting concepts and conventions. The first one is business entity concept. Money measurement concept, it is also known as stable monetary unit. Going concern concept, historical concept, prudence or conservatism, and materiality, objectivity, consistency. The another one is accruals or matching concept, the realization concept, uniformity, disclosure, relevance, and accounting period concepts. These are the different concepts are available in financial accounting. So, I am going to explain one by one along with the examples for better understanding purpose. First, I will go for business entity concept. What do you mean by this? See, the business entity concepts are the business and its owners are two separate existence entity. Means the business is different from its owner. Basically, what does it mean is business, any private and personal incomes and expenses of the owner should not be treated as the incomes and expenses of the business. It means business is entirely different from its owner. Owner is having its own incomes, its own expenses, but that not be the expenses and incomes of the business. Business entity means business is separate from its members. Right. What are the examples of that? See, just I would like to go for insurance premiums for the owner's house should be excluded from the expense of the business. That is related to the owner. That is related to the member. Members are different from its business. Again, the owner's property should not be included in the premises accounts of the business. Again, any payment for the owner's personal expenses by the business will be treated as a drawings and reduce the owner's capital contribution in the business. So, business entity concept is nothing but it is entirely so the business is considered to be separate from its owners. So, the business transactions are recorded in the books of account from the business point of view, not the owners. These are the different examples. Insurance premium of the owner is not the expense of the business. Owner's property is not a land and buildings of the business. Any payment owner's personal expenses will be treated as a drawings. That is the first and foremost concept. Having said that, let me move on to the money measurement concept. The name itself indicates what do you mean by the money measurement concept. See, here the money measurement concept is transactions and events. All transactions of the business are recorded in terms of money. So, the transactions and events that can be measured in money terms are only recorded in the books of accounts. In other words, we can also say in this way, money is a common denominator in recording and reporting the transactions. These concepts make accounting information more meaningful. It provides common unit of measurement for analysis of financial statements. So the all the transactions which are measured in terms of money will be recorded in the books of accounts. So for examples, some there are some limitations for these market conditions. Efficient management, efficient leadership, technological changes are not to be considered as a financial transaction, so that is not disclosed in the accounts. So there are some limitations, but still money measurement concept playing vital role in accounting terminology. Then, having said that, the going concern concept. What do you mean by going concern? The simple way we can make you understand is men may come and men may go, but the company goes on forever. Means, what does it mean? It is assumed that business shall continue for an indefinite period, and there is no intention to close the business and its operations significantly. So what it is mentioned, the business will continue in operational existence for the future, foreseeable future also. So accordingly, what I would like to mention here is financial statement should be prepared on a going concern basis unless management either intends to liquidate the enterprise or to cease trading, has no realistic alternative but to do so. So, for example, a machine is expected to last 10 years. The cost of machinery is spread to the suitable basis for for the next 10 years for ascertaining profit or loss for each year. The another example, possible losses from the closure of the business won't be anticipated in the accounts. And prepayments. Depreciation provisions may be carried forward in the expectation of proper matching against the revenue of future periods. So, and fixed assets are recorded at a historical cost. See, that is the going concern. Now, I will go for the historical cost concept. So, what do you mean by this? Assets should be shown on the balance sheet at the cost of purchase instead of current value. The market value won't be considered while recording the assets value in the balance sheet. The best example is the cost of fixed assets like land and buildings, plant and machinery, furniture and fittings. All these are recorded at the date of acquisition cost. What does that mean? At the time of acquiring the asset, at the time of purchasing the asset, the cost includes all expenditure made to prepare the asset for its intended use. It includes invoice price of the asset, freight charges, insurance, and installation cost. All these will be included in the cost concept, historical cost concept. The other one is prudence, or also known as conservatism. What do you mean by this? So, revenues and profits are not anticipated. In future, I am going to get some revenue, I am going to get some profit. You should not anticipate and you should not record those transactions. What you have to do is see only realized profits with reasonable certainty or recognized in the profit and loss account. However, provision is made for all known expenses. I am telling you that don't anticipate profit, but however, you have to provide provision for all known expenses and losses, whether the amount is known for certain or just an estimation. So here the one phrase is there, don't anticipate a profit but provide for all possible losses. In other words, it takes into the consideration of all prospective losses but not the prospective profits. This treatment minimize the reported profits, the valuation of the assets. The best example is stock valuation. So to lower cost and not realizable value. Provision for doubtful debts we can make because bad debts may be future losses. So fixed assets must be depreciated over the useful life. Then other concept I need you to understand is the materiality. What do you mean by materiality? It refers the importance of an item or an event. So, immaterial amounts may be aggregated with the amounts of similar in nature or function need not be presented separately. How materiality can be defined or depend? It depends on the size and nature of the item. So, the best example is small payments such as postage, stationery, cleaning expenses should not be disclosed separately. They should be grouped together as a sundry expenses. Another example I will make you to understand that the cost of small valued assets such as pencil, sharpeners, paper clips should be written off to the profit and loss as a revenue expenditure, although they can last for more than one accounting period. So again, I'm going to tell you, as per American Accounting Association, an item should be recorded as a material if there is a reason to believe that knowledge of it would influence the decision of the an informed investor. For example, amount spent on repairs of the building, say 2,50,000 is material for an enterprise having turnover of around 50 lakhs. But it is not that material for an enterprise having turnover of 15 crores. So it is depend on the size and nature of the business and turnover of the business. So in keeping the view of the principles of materiality, material items are disclosed, whereas items that are not material are either left out or measured with some other items. After having said that, let me move on to the objectivity. What do you mean by objectivity? So, objectivity is nothing but unbiased. So, the accounting information should be free from bias and capable of independent verification. So here I would like to mention that the information should be based on upon verifiable evidence such as invoices or contracts. The best example is recognition of revenue should be based on the verifiable evidence such as the delivery of the goods or issue of invoices. Another concept I would like to make you understand that is a consistency. The name itself indicates consistency. So, accounting practices once selected and adopted should be applied consistently year after year. Means companies should choose the most suitable accounting methods and treatments and consistently apply them in every period. Of course, changes are needed, you can change, but changes are permitted only when new method is considered better and can reflect the true and fair view of the financial position of the company. Of course, change and its effect profit should be disclosed in the financial statements. So, the examples are if a company adopts straight line method and should not be changed to adopt reducing balance sheet in another period. So, if a company adopts weighted average stock method, stock valuation method should not be changed to the first in first out method in the next accounting period. That is the consistency you need to maintain. Then another one, accruals or matching. So what do you mean by accruals? Revenues are recognized when they earned, but not when the cash is received. So this transaction is recorded at the time when it is entered into, not when the settlement takes place. So one more thing I would like to make you understand that expenses are recognized as they are incurred, but not when the cash is paid. The net income for the period is determined by subtracting expenses from the income or from revenues earned. Example is expense incurred but not yet paid in current period should be treated as a accrual, means outstanding expenses and current liabilities. Similarly, expenditure incurred in the following period but paid for in advance should be treated as a prepaid expenses under current asset. And depreciation should be charged as a cost of fixed assets consumed during the period of use. The other one, there are some problems in the recognition of revenue normally. Expenses represent resources consumed during the current period. Some cost may benefit several accounting methods, several accounting periods. For example, development expenditure, depreciation of fixed assets. So there is a association between cause and effect. Expenses recognized on the basis of direct association between the expenses incurred on the basis of direct association between the expenses incurred and revenues. And for example, sales commission should be accounting for the period when the products are sold, not when they are paid. Systematic allocation of cost. The cost benefits several accounting periods they should recognize on the basis of systematic and rational allocation method. Provision for depreciation should be made over the estimated useful life of the fixed asset. Immediate recognition. If the expenses are expected to have no certain future benefit or even without future benefit, they should be written off in the current accounting period. That is stock losses, advertising expenses, research cost, all these. Then the realization concept. See, it is also very important concept. Revenue should be recognized when the major economic activities have been completed. So, according to the realization concept, revenues is considered to have been realized when the transaction has been entered into and the obligation to receive the amount has been established. Sales are recognized when the goods are sold and delivered to the customers or services are rendered. How it can be recognition of revenue? The realization income develops rules for the recognition of the revenue. The concept provides the revenues are recognized when it is earned and not the money is received. These are the revenue recognition. So a receipt in advance for the supply of goods should be treated as a prepaid income, as I mentioned in the revenue recognition concept. Since revenue is a principal component in the measurement of profit, the timing of its recognition is also direct impact on the profit. And recognition criteria for revenues. Revenue recognized, major earning process substantially should be completed. The buyer has admitted his liability to pay the goods or services provided by the ultimate collection of the relatively certain. So, the best example is the realization concept. An enterprise has received an advance of February 2024 for the sale to be made in 2000 May 2024. Revenue shall be recognized in May 2024 upon sales having been made, because the legal obligation to receive the amount has been established in the May 2024. So it is not that if you take the advance you have to make the what you call transactions. So whenever there is a May 2024, revenue shall be recognized in May 2024. So the buyer has admitted the liability to pay the goods or services provided the ultimate collection certainly realized. Another example, goods sent to our customers on sale or return basis. This means the customer don't pay for the goods until the confirmed to buy. If they don't buy, those goods will return to us. Goods on the sale or return basis won't be treated as a normal sales and should be included in the closing stock unless the sales have been confirmed by the customers. The problems, revenue recognition when there is a sale. The point of sales in the earning process is selected as the most appropriated time to record revenues. However, this revenue is earned in a long and continuous process. It is difficult to determine the portion of revenue which is earned at each stage. So what we need to do is revenue is permitted to be recorded other than at the point of sales. So there are some exceptions. Long-term contracts won't be taken into account about the realization concept, and hire purchase sales have long collection period. Revenue should be recognized when the cash received rather than when the sale is made. There is a some what you call some limitations, some exceptions for the recognition. See, long-term contracts owing into the long duration of the long-term contract. Part of the total profit estimated to have been arisen from the accounting period should be included in the profit and loss account. And received from subscriptions. If a publisher receives subscription before it sends newspaper or magazines to its customers, means it is proper to defer the revenue recognition until the service is rendered. However, part subscription income can be recognized as it's received in order to match against the advertising expenses incurred. So the another concept is disclosure. What do you mean by the disclosure? Means concept of full disclosure in the sense there should be complete and understandable reporting on the financial statements of all significant information relating to the economic affairs of the entity. means financial statements should be prepared to reflect true and fair view of the financial position and the performance of an enterprise. So all material and relevant information must be disclosed in the financial statements. Uniformity, we have to maintain uniformity while preparing or recording accounting transactions. Means different companies were within the same industry should adopt the same accounting methods and treatments for like transactions. That practice of enables intercompany, means one company to another company comparison of their financial positions. The another one is a relevance concept. What do you mean by this? So it means finance statement should be prepared to meet the objectives of the users. So relevant information which can satisfy the needs of the most users, stakeholders, is selected and recorded in the financial statements. The last one is a accounting period concept. Basically, once accounting period we have to consider, usually it is a 1 year. Means according to the accounting period, or it is also called periodicity concept, the life of an enterprise, the life of an organization, the life of a business is broken into small intervals. Usually it will be the 1 year, so that is its performance is measured at regular intervals. So calculating accounts for more than one accounting period will be tedious. So one accounting period will be considered. It enables the users of accounting information to take timely decisions that may be required according to the current business situation. Also, the government can assess the tax liabilities of the enterprise for the year. These are the accounting period concept. Thank you. Thank you for watching. Thank you for staying with me. Thank you for support and encouragement. Thank you, one and all.